My phone isn't working, dog. Hold on, Ammar. It is thinking. All right, now we're redirecting to YouTube. All right, looks like we might be on there. Hold on. Second. There we go. All right, cool. So I just mute that. All right, cool. So it looks like we are live, Big Daddy. All right, hold on. Let me just do this right here. Come over here. Slide that down just a tad. All right, cool. All right, good stuff. So we'll wait for a couple other people to jump on there, Amar. So what's going on? Can you smell the fire, or what's going on out there? Can you smell the burning and stuff, or what?
Like let's say a week ago we could,
Yeah.
but not anymore. Now it's because we're in San Diego. The Valley Fire is pretty much cleared up.
Oh, it is? Okay.
Yeah.
Was it bad?
Yeah, I mean, my car had ash all over it, and we're like,
Man.
10 to 15 miles away.
Crazy, man. So they're able to get it out, though? They're able to put it out?
Yep.
That's good. So it's it's pretty much gone for the most part in terms of the ash and the smoke and all that?
Yep.
Yep. That's good. Right on. All right. So what's been going on in the world of Ammar's business?
Trying to go digital. So we're back on YouTube.
Yeah. Okay.
With a little hiatus there, but trying to put educational content out there for people to watch and learn.
What was the last video you posted? When was it?
Last week.
Okay.
It was the different, accounts are taxable in different ways, right? Like, so the difference between a non-qualified account, an IRA, and a Roth IRA.
Right.
Yeah, so we were going through that.
All right, cool. Good. And all right, so we'll put links in the show. There we go. All right, sweet. Let me bring up your channel so I can put a link in there. Hold on just a second, Ammar. So, and then we'll dive into this a little bit. All right, so we're gonna go to it's what's your YouTube channel again, Ammar?
Client First Capital Learning.
There you go. Cool. All right on. Let's bring this up, and so we will put a link in the show notes. All right. And right there. All right, so folks, if you so here's Ammar's YouTube channel. So let me just briefly introduce what Ammar. It's been a while since we did a live stream together, man. It's probably been, I mean, how long has it been? At least 8 months or so, right?
I don't think maybe.
All right.
I think we did one in March last, or maybe it was right before the COVID stuff.
COVID. It's gonna kill you, Ammar. It's gonna kill you. You're gonna die. So Ammar and I used to know each other at USA. We worked together there, and Ammar was in our San Diego office while I was in our Atlanta office. And we just both moved on to greener pastures, and we'll kind of leave that as that, if it were, as it were. Jason, who I did a live stream with the other day, also works for USA. In fact, Ammar introduced Jason to me, and so Ammar and Jason work together in San Diego. And I think Ammar does jujitsu on Jason to practice because Jason's got that.
It's funny because Jason works with me, and I can't piss him off because he's like a trained killer, right? It's like
and a surfer too.
Yeah.
But so Ammar, I was trying to encourage Ammar to go on his own, because I said, look, man, it's just at the end of the day, you can do the financial planning that you want to do as opposed to being told how to do it from above. And as I've talked about many times on this channel, the corporate people, it doesn't matter what firm, they tell you how they want the financial plans done, and it's done to benefit the corporation. Just all there is to it. And you cannot convince me otherwise. You just can't. And both Ammar and I, Jason, everyone just gets like at some point say, I gotta go on to something, because this isn't, it just doesn't, it's not sitting kosher with me. And USA was about the better of them all. I will tell you right now, they give us a lot of flexibility to do real financial planning, unlike a lot of folks. So anyway, Ammar manages money. I don't get paid. I have no relationship with Ammar in terms of financial thing. Nothing. Just Ammar as a friend. I like to introduce people who are doing the good business that should be done. In fact, Ammar, this is gonna piss you off. I was talking to a guy today, and it just freaking pisses me off. He's paying 2% a year.
Oh, ouch.
A year. And he has this thing where he said, and I'm not gonna get into it. I'll do another video on it. But he has a thing on talking about his his risk adjusted performance. Now, he's one of the top risk adjusted performers in the business, but it's all gross. It's all gross. And I say that's freaking bull crap, dude. You're going to say I'm one of the top risk adjustment guys. It's all gross. And you're paying 2%. That's freaking nuts. And the crazy thing is all the other people, except for the funds, so that he's competing against funds and stuff, they all show gross too. And it's just, the whole thing is corrupt as the day is long, this business. And it infuriates me. It doesn't have to be like that. And so Ammar's a fiduciary, registered investment advisor, a CFP, CFA, all around good guy. He's got 2 kids now, Ammar, is that right?
2 kids, 2 girls.
Yeah. So, just for, because the channels are forever expanding and ever going up and down and up and down. So just Ammar, take the mic and tell people who you are, and we'll just go from there.
Yeah. So, well, Josh, you did a really good job introducing me, so I don't know how much more I can say, but
experience and stuff. I didn't say that.
Yeah. So, I mean, I've been in the industry for 16 years, and I started off my working career as an engineer, so very analytical, and then transitioned to American Express, to JP Morgan, to USAA, where I met Josh. And in 2019, I started my own firm. So we're a small firm. We focus on clients and tailor make the solutions, right? So we don't have just one portfolio that we throw all our clients in, or different risk tolerances that we throw our clients into the different buckets. So it's tailored financial advice.
Yeah. And there we go. So I had it just on one person. Okay. So I don't know if you use Zoom, Ammar, if you want side by side, you got to click on it where it says speaker view. Now you're not using Zoom anymore. Is that right? You're using this other thing, or?
Yeah. So maybe next week or the week after, I can show you this StreamYard. It's really cool.
StreamYard. Yeah, that sounds fantastic. Absolutely. Right on. Because Zoom's okay, but it's all right. Anyway. So what we want to talk about tonight. So Ammar, what's your take on the lay of the land investment wise? Let's just go into that for a little bit. Thought in terms of what you see going on in the market, what's happening, what do people need to be prepared for, things of that nature.
Yeah, I mean, everybody out there has an opinion, right? So, but nobody has a crystal ball to kind of predict what's going to happen. So
we all have crystal balls.
That's why we're on YouTube. So like, from our perspective, we view what we chart is the rate of change between inflation and growth. And so for a while there, we had decreasing inflation and decreasing growth. Mm-hmm. Think about when COVID first hit in that time horizon. Then we transitioned to a period where the growth was still decreasing, but then we had an uptick in inflation. So if you just look at the cost of lumber for the last 3 months, or even milk at the grocery store, things are getting more expensive. And that's because we had a declining US dollar. And so, with Congress not getting together to get another stimulus package or some sort of MMT or something like that to help everyday people, I think it's, we're going to have a slower recovery than most people think. And so for that, we're kind of being very defensive overall. So we're using things like government bonds, low volatility, large cap companies. We have a defensive position in gold and stuff like that. So, I mean, you have to have a diversified overall portfolio, but then you tilt those portfolios based off different sectors. And in the big scheme of things, we're still being quite defensive.
Okay. Are you quite defensive, like more value tilt? Is that what you're saying?
Yeah. So, we're at a blend right now. We're not tilted one way to growth or value. Value should have a rebound. I mean, value's been eating the dogs here for like the last 10 years or so. So value should rebound. But no, when I say defensive, I'm saying that, like, for example, in bonds, even within an IRA, we have a 20-30% allocation to government bonds. So we're more worried about safety of principal than rate of return. Eventually, so the Fed has these things called SPVs, which are special purchase vehicles, and they're going out and they're buying junk bonds. Well, what happens when those junk bonds default, right? And so those companies, we're seeing an increase in those companies, which in the industry, it's a jargon term called zombie companies, where essentially the companies make enough to pay their debt back, and they have very little margin for profit. And we think that's a bad thing, because a lot of these companies getting into this crisis, they already had too much debt, and now the government's just piling more debt on, right? So we don't find
the government is lending money to zombie companies just to keep them like airlines or something like that. Like who?
Yeah, I mean, across the board, right? I mean, so airlines is one of them, right? That has huge overhead.
Yeah.
I mean, in the last 3 months, we've seen the airlines do a lot of transition packages for employees, right? But this is more, other companies where, to have a good working economy, good companies have to succeed and bad companies need to fail.
Yeah.
But the Fed is bailing out all companies, so even bad companies are getting a lift up in terms of protection.
Where is the friggin' money coming from for Delta to offer? I mean, because I've got a bunch of Delta clients, and I'm just sitting there thinking, where is this money coming from? So these buyouts. And I'm not just picking on Delta. I'm picking on, I mean, where is this money coming from? From the government or what? You know what I'm saying?
Yeah, I mean, so I believe a portion is coming from the government, right? And so they have access, like these airlines have access to the lending directly through the Fed. Another thing I think is that a lot of the larger companies have structured debt, right? So they have debt that's maturing that may be at 4, 5, 6, 7%. And they're able to take out that new debt at close to 1 to 2%, right? Like hypothetically, I haven't done company specific research, but then your outflows to service that debt have dropped.
Yeah, it's cash flow without question. Still, at the end of the day, how about your thoughts on dividend companies? Are the dividends pretty solid? Do you think you got some concerns about dividend payers, or what do you think?
Most of the blue chips, they still seem to be solid overall. I think one of the concerns is that dividend growth, right? So like a lot of the companies that pay a dividend, how they're ranked in some of the funds is the growth of their dividend. And some of the dividend growers are definitely having,
not seeing the growth as much as what we'd be hoping is what you're saying.
Yeah. And another thing to think about, like if we look at real estate companies, right, which a lot of people that are focusing on their dividends and interest for income, they may take on more risk because they're chasing yield, right? And one of the things that we see is some of the real estate companies, they're borrowing money to pay their dividends.
Yeah, that's the concern I got, Ammar. Is that exactly. Not just on real estate companies, on any company. Yeah, if they're borrowing money to pay the dividends, that's not good. Are you seeing that more in the real estate side of things and then just the regular, corporate?
Yeah, I mean, I would say throughout the industry, right? We're in uncertain times, right? And like a lot of these companies, that's why the events like this are like a shock to the system, right? Because if people knew, then they wouldn't be doing these share buybacks like in January 2020, right? So like, and I bet those companies wish they didn't do that and had that cash on hand now, right? And so,
or they could have bought back in March of 2020 at a hell of a lot cheaper price. You know what I'm saying?
Yeah.
How much cash is a typical portfolio under the Ammar you keep? I mean, do you have is it specific to the client, or do you have a generalized amount? How much cash?
It's always tailored to the client, right? So depending, there could be pension incomes, there could be Social Security that would offset the need to have cash, but typically, you want to have at least 1 to 3 years of your core expenses in some sort of structured cash position. So that's short-term CDs, short-term T-bills, just even a money market account or a bank account with high yield savings which those are no longer high yield.
Yeah.
I think I saw one of the high yield ones online drop below 1%.
That is
2
high
weeks ago.
yield. Are you expecting inflation though? I mean, it sounds like you're kind of geared towards you think inflation is imminent, and I don't want to put words in your mouth. Is that your thinking?
No, I mean, we're tracking 3 to 5 year numbers, right? So we try to position our portfolio against a 3 to 5 year.
Yeah, no, I got you.
Till-
So you think 3 to 5, we could see an uptick, or
I mean, we printed all this money. It's got to go somewhere, right? So we're already seeing asset values get inflated.
yeah, right.
We saw a blip of, commodities go up. Like if you pull up a commodity chart and you look at the last 3 to 6 months, commodities
Like
have
you said,
gone up.
lumber is going through the roof.
Yeah.
There's a
But
guy named uneducated economist Simon from Astoria, Oregon. I watch him on YouTube, and he's in the lumber business. And I've been tracking him on the lumber stuff. It's like 1,000 per. I can't remember what he said, sheet of ply. I can't remember what he said, but I was like, damn, dude. He said he's never been that high before ever. And I don't know if that's a huge because of the demand. I don't know. But it's nuts.
Well, I can tell you here in San Diego, new housing permits are still up. And so there are delays between 7 to 10 months because people already had plans in place and money set aside. Now, the cost to build those houses have probably gone up, by 7 to 15% just for the cost of the lumber piece.
Actually, let me real quick for folks who are watching. That's actually a good point, a good segue into the insurance stuff. But remember, folks, if you have a homeowner's policy, you want the rebuild cost, because the rebuild cost is certainly higher than what your fair market value is most likely. So if you're looking at your homeowner's policy, which no one does, and you should. Oh boy, here comes a little nugget. Remember, here he comes. When Pablo comes, you got to paw the like button. I hear him with his little toy. You got to check the homeowners to make sure you got rebuild costs because it's nuts now. Ammar, we got a pool installed this summer, and we're thinking, man, we're hesitant to do it, but we already have the plan. We just said, let's just go. I had saved a good amount of money towards it. It's like, let's just go forward with it. And the friggin' price of pools have gone up 20% because there's so much demand for pool. Like they literally. The guy says, I can't talk to people who call me anymore. I was like, damn, that's crazy. I would have thought it'd been the exact opposite. You know what I'm saying? But everyone's like trying to make their own home as their vacation land because of the commie virus. It's nuts.
Exactly. Yeah. So I know a lot of people are doing home projects, extensions, redoing their landscaping. Being at home, I mean, with COVID, it's hard to say mentally staying sane in the environment that if you're just trapped inside, right?
Yeah.
So being outdoors, having outdoor, I mean, heck, we bought it at first. We bought a trampoline for the girls to keep them occupied at home, but we soon returned that, and then we're doing some other stuff. May hop on the RV bandwagon. Everybody's buying an RV. I've been on 2 RV trips. I've enjoyed those thoroughly.
I know. Why'd you return the trampoline?
Safety.
Yeah.
So we don't have a level place to put the trampoline, so it would be on an angle kind of, and the legs wouldn't level out the trampoline. Yeah. I don't want kids bouncing in the angle going out. That's the engineer in me. If it's not perfect, we gotta redo it.
I'm saying, man, that sounds like that sounds like redneck engineering, and you are the engineer in you. I was like, why did you get that? But so you're like, nah, we're not playing with it.
Yeah.
No, right on, Ammar. All right, so did you need to do disclosure now or after we're done, or what?
Let's just do it at the end. That's why if people want to hop off, they can. If they want to listen to the full disclosure, we don't have to play it at 2 times speed.
Yeah, right.
It's only a minute, but still.
Yeah. So Ammar, because he's a registered investment advisor and actually handles money, he's got to check the boxes that says, "Did you tell people that you were blah blah blah?" So all right, how to use life insurance with the trampoline. So that's a good one, man. So let's all right. So Ammar and I came from USAA. All right. Now Ammar was before at USAA was with JP Morgan, something like that. I was before that was with Smith Barney. So we weren't bred on USAA, but USAA is an insurance company. And because of that, we probably have more experience on insurance than a lot of other financial advisors do. And the life insurance category, I think, is one that gets underutilized in the right mechanism. and it gets overutilized in the wrong mechanism, but underutilized, especially in estate planning. I am not licensed to sell life insurance. I have no commissions, nothing. That's not me. My man Ammar is though, and because of that, I was asking him to get on, and he actually gave me an illustration on a second to die life insurance policy, which I've always been a huge fan of, and I actually have done a couple of videos on second to die survivorship life insurance. But Ammar is going to go over how to use this for your estate planning, because I think, especially if you have a lot of deferred accounts, we'll let Ammar take over this. But man, it's such a wonderful strategy that I think very few people use, because they hear life insurance, no, evil. That's just wrong. So yeah, Mark, take it away, man. And when the questions come in, I'll let you know.
Okay. Well, before we start, I want to go over some like basics of life insurance.
I'll probably just put you on here, and I'll minimize myself, so that way, because you can share your screen, right? Is that what you're gonna do later?
Yeah, let me share it right now. Can you see me?
Cool. Yep, perfect. Right on. There you go. Right. Wow, you're good, Ammar. Sweet. Wow.
All right. So it says it's paused.
You're looking down. I'm just trying to follow the comments. So right on, man.
So let me do whiteboard. All right. So the first thing I want to talk about is maybe just the basics of life insurance and what we're talking about, and then go into a strategy of why it could make sense for you. Mm-hmm. And then from there, go through a couple of illustrations to outline some key points, right? So the first thing I want to say is that, in the world of insurance, there's basically two types of products, right? There's term insurance and there's permanent. And I want to highlight the key difference here. Here is the dollars equal the cost of insurance. Over here, your dollars that you put into it do not equal the cost of insurance. Okay? And here, the cost of insurance is basically what does it cost per thousand to insure whatever death benefit that you have. So the part of that is the cost of insurance. I'm horrible at drawing on this thing.
Get your daughter to do it. She'll probably draw better.
Yeah, probably. I don't know if that you can see that, but so here's some. So your premiums going in do not equal the cost of insurance. It's actually greater, and that money, some of it goes to the cost of insurance. Some of it goes to investments. Those investments get a rate of return, and they go back into the policy, right? So this is the fundamental difference between term and perm. What Josh and I are going to talk about today is a permanent policy, but this cost of insurance is based off of two people's lives.
Exactly.
Right? So it's not if one spouse passes away, it's if both people pass away. Second to die. So it's a second person to pass away. Because of that, the probability that two people pass away in the earlier years is quite low, right? Especially relative to one person. Yeah. So the cost of insurance goes way down. So that's like the first point that I want to kind of illustrate to everybody. And save that. Clear. And Josh, if there are questions that come through, can you just shout them out?
Yeah, no, absolutely. Yep, absolutely.
Right. The second point that I want to get across is that if you look at a policy, and this is the death benefit, and for argument's sake, let's just say it's 500,000. When you put in premiums up, you're building this right here, which is cash value. So this amount is kind of like self-insuring right here.
And that's on the permanent. Just remember, folks, that's the permanent. The term we're not talking about here.
Yeah, we're not talking about term. We're talking about permanent. So this is cash value. It's kind of like the self-insurance part of it. There are different funding levels for these policies, and we'll go through one of them to give you all the different levels, right? So this is max funding it, all the way to the top. This is minimum funding. And then there's some base cost of insurance, right? So you could put premiums here. You may decide like, hey, I have a lot of money, so I'm going to put more premiums over here, this amount, fund this amount. And you could just be, you can say, hey, I don't know what the future likes. I want to fund this as much as possible. And you could be putting in the max every year, right? So depending on how much you fund a policy each year, so hypothetically, this could be year 1, 2, 3, 10, etc. You're going to have different funding levels of cash value, right? So the point I'm trying to make here is that this cash value, and I think this is still red.
Yep.
Yep. So this cash value, if you overfund a policy, will start to go up. If you underfund a policy, the cash value will go down. And there's nothing that's absolutely good or bad of either. There are advantages and disadvantages depending on how you design the policy. So when you overfund a policy, one of the advantages could be is that your death benefit could also increase. So if you had a cash value that was going like this, since that's a state insurance policy, your cash value could also increase. If you underfund a policy, the cash value could go like this, and the death benefit could be like to here, and then all of a sudden here go down to 0, right? In the situation that Josh and I will talk about later, one of the questions that we have is the reason why we're buying this insurance is to get the most amount of leverage out of a policy. If we want to get the most amount of leverage out of a policy, you don't want to put the most amount of your money into the policy. So if that makes sense, let me just state that. Did that make sense, Josh?
I think so. But if you have another way to explain it, sure.
Yeah,
I think I know what you're talking about, but yeah, if you have
yeah. So another way of saying this is that to get the most amount of leverage, you have to put the least amount of money in.
It's like not putting any money down on your home. If you buy a house with no down payment, you're getting the most amount of leverage.
Yeah, exactly. And so, the last thing that I want to say is, we're talking about permanent insurance, and we talked about the cost of insurance being cheaper because we're insuring 2 lives. The second slide, we talked about the difference between overfunding and underfunding a permanent policy, right? And so the third thing that I want to go over here is what is the strategy around?
Exactly.
What is the strategy, right? So we all know.
Can I interject real quick? On the strategy thing, this is a big issue I have with a lot of the life insurance people is that they don't. Hey, buddy, thanks, babe. The like button is that they don't get to the gist of what the strategy is, and without knowing the strategy, it's impossible to design the proper life insurance plan. As such, that's why life insurance gets that's a bad rep, because people just say this. It's like if you're a hammer, everything's a nail, and so if you're talking life insurance, we got to figure out what we're trying to solve. All right, just go ahead, Ammar. I appreciate that.
Yeah, no, and that's good. It's part of having a structure and then revisiting that strategy over and over again, right? So here, the second to die policy is that if this is, these are clients, I'm not an artist, but one's a guy, one's a lady, and they have a large estate and they want to get money out of their estate, right?
And what would you say is a large estate, if you want to just call it?
Well, we don't know, because estate tax exemptions are always changing, right? So a couple of years ago, Josh, you remember right before Obama, there were like 1 million to 3 million, then they went to 5 million. Then President Trump came in and made them 10 million per person. Today, that's $11.3 million exemption. So think about the estate being what is a large estate is considered whatever's above the exemption amount that's subject to estate taxes.
Does California have an estate tax?
Nope.
Okay.
But that's a good point. States also have an estate tax for depending on the state, right? Yeah. So if you're in Illinois, if you're in Massachusetts, I mean, there are state estate taxes as well. So one of the thoughts is to do your annual gifting. So let's, if you have, let's say 2 children, And I guess red is not a good color to use for this because it may not show up.
Showing up.
I don't know if
there you go.
So right now you can do your annual gifting of 15,000 per person, right? So mom and dad can give your son or daughter 30,000 each, right?
Yep.
If you're maximizing the gifts, right?
It's just a strategy, exactly.
It's a strategy, right? And maybe it's 5,000.
Exactly.
Or maybe it's 1,000. I'm just giving you what the max is.
Exactly. Yep.
And
Mark,
so
just real quick again. I also think people say that won't apply to me. I don't have 15,000. It could be $500. It could be anything. It's just he's just showing the 15,000 because that's the limit where you don't have to file a gift tax return.
Yeah. So this is the limit that you don't have to file 709, right? Exactly. So like so right. Like it could be even a couple $100.
Exactly. Don't get caught on this amount because it's completely contingent on you. Just because we're using 15,000 doesn't mean you have to be a rich guy to do this. You don't have to be a freaking Jeff Bezos. All right. So yeah, keep going, man.
Yeah. So the idea would be to have a policy that's bought outside of your estate. So it's not in your control, right? In terms of it's not brought into your estate for estate tax exemption amounts, for estate tax calculations. It's outside your estate. And what happens is that the parents would fund whatever the premium, let's use a round number, let's say 3,000 a year or whatever the dollar amount is, right? Or let's just.
That's good. 3,000 a year. That's fine. Absolutely.
So mom and dad can give their children $3,000. They have to wait 30 days. Sometimes there's a crummy letter that's associated with this. And the crummy letter basically states that, yes, I've received the money from my parents. I know I can go spend it, but I choose to invest it into this policy. And then they take that money, put it towards the premiums of this policy, and then this dollar amount grows outside mom and dad's estate, right? That is really a way of moving assets out of your estate, avoiding the estate tax exemption amounts, and then also you can put more controls over those money in the terms
who
of.
Owns that 500,000 policy? The kids?
No, the trust does. So there's this trust in the industry. It's called an ILIT, which is irrevocable life insurance trust. And so the idea here is that we're trying to move assets outside the estate, but maintain control of how it's distributed. So here you could say, upon mom and dad's passing, there's going to be 5% of the account value that's distributed, or you can have HEMS, which is health, maintenance, and support, right? You can put different things that are important to you, right?
Now, who's putting that on there? The grantors, mom and dad, or the kids?
Mom and dad. Mom and dad. Yeah. You could also do generation skipping trust, where it's like, hey, my two children, they're smart, they're successful, they have good jobs. One owns a business, one owns a doctor. They're never going to need this money, but I want it to go to the grandchildren, right? So you can make the gifts instead of to the kids, to the grandchildren, to the trust. This is the way that these policies have traditionally worked.
Yeah.
What I want to do is show you an example of, with the new Secure Act, what are some things that you need to maybe kind of put in play to make sure that we're extending control of those assets. So I'm going to give you a real life example. So I know I have a prospective client that has $750,000 in their IRA. And that client, their spouse is deceased, has two children. One would spend every single penny that they got. One would save every single penny that they got. So two totally different personalities. Another example could be like if somebody has special needs, right? Yep. So think about the Secure Act. If $750,000 IRA goes to a child, they have 10 years to distribute that money, and it's all taxable income, right? So that would kick off, let's say somebody's on a Social Security for special needs, their income would kick them off of the Social Security benefit, right? If you have a child, like in this example, that would spend every single penny,
Exactly.
and you don't want them to have access to every single penny, well, what do you do, right? Because before you could create a retirement trust and they would only be able to take the required minimum distribution out. Well, that strategy is out the window now. So one of the things that we've talked about with this client, prospective client, is that the fact that they're also charitably inclined, right? So what we could do is we could take the required minimum distributions out of this policy, fund a trust that owns a life insurance policy, right? So this is the ILET. Now he can put stipulations on distributions of these assets, right? And have the remaining balance of this IRA go to a charity.
Yeah.
So the beneficiary is now a charity.
Awesome.
So, and you know, if you're charitably inclined, you can list as many charities as you want, right? I mean, you don't have to limit yourself. But so just look at what we did here. So the children, now the money is put in a trust, and he can have distributions, like control of how the assets are distributed. And so he doesn't have to worry if the kids will spend through all the money or not, or if there's a divorce, or if, you know, there's so many different levels that you can go through. So Josh, are there any questions so far? Because we're going quite
why
fast.
not just, why even have the islet? Why not just have the kids have the you know,
You can just have the you can just have the kids own the policy too. The in this example, the reason why we have an islet is because we want to control the distributions out of the trust, right? So in this, after
exactly. Yeah.
the husband passes away, we want the children to only get 3% withdrawal plus HEMS.
Yeah.
Right. The other issue is that, you know, they owned a second to die policy in their names before one spouse passed away. So for us, what we're doing is we're taking, remember I said those, you can have a policy that's overfunded and the value keeps growing, or you can have a policy that's underfunded and it's going to lapse, right? They have a policy that was underfunded.
Yeah.
That now we're going to turn around and overfund.
Yeah. Because they've already been it's already in force.
It was already enforced, yeah. So these two individuals are, or the client himself is older.
So go over the reason you want to use the IRA to give charitably. Why not just give the money to the kids and then give the IRA with other money?
So the reason is that we're taking money out of the IRA and basically, let me draw this out.
Does that make sense? The question I'm asking, Amar?
Yeah. So here, let's say you have two buckets of accounts. You have an IRA and then you have your taxable account, right? In the IRA, it transfers by operation of contract. So you just put a beneficiary on here, right?
Yep.
You put both kids, but you don't control how those kids spend down that money, right? So the reason why we created the trust is so that trust, we spend down the IRA. In the trust, we can have stipulations of how the money is distributed. Am I explaining that correctly, Josh?
Yes, but there's a second reason for that too, about the tax consequences on the IRA that goes to the charity as opposed to the kids receiving an IRA would much rather.
Yeah, I mean, yeah. So the main purpose was to retain control of distributions. The second and third degree benefits are your kids are not paying taxes on ordinary income, right? So they have their income plus the distribution of the IRA. Your taxable assets get a step up in cost basis most of the time versus IRAs do not, right? So there are other things there to consider.
Well, so just FYI, so what's happening here, guys, is we'll just use my kids. My kids every time would want to inherit a post-tax asset or life insurance. So of all the stuff to inherit, life insurance is probably the best because it's always tax-free. I hate to say always, there are, but generally speaking, most life insurance is tax-free. A mutual fund portfolio outside an IRA is second best. And then the last thing my kids want to inherit is the IRA, because like Ammar was saying, there's have to pay tax on that. The money that is left to a church, for instance, from your IRA goes to the church tax-free because it's a charitable distribution. And that's what makes it freaking awesome, is that you're saying, look, I can take care of my kids and I can take care of the church basically on the same money. And on top of that, because life insurance on the second surviving spouse, and Shah and I have one of these, and it's not based on me, a crusty old man 4 years older than my beautiful, who's 4 years younger, a hell of a lot smarter. It's based on her life expectancy. So it's cheaper than just doing it on me. So lots of tax strategies too. Now, David says, whole life, Ammar. So would you do whole life would you make your whole life, the trust as the owner of your whole life insurance? So talk about what types, we talk about perm, but maybe divide down even further on the two different types, if you would.
Yeah, so I can do that. So I guess that was horrible. I need to get a ruler on my computer.
We just need to get one of those scribble things, man. One of those scribble pads. You know what I'm saying? I have one, but I just never use it. Too lazy to set it up.
Yeah. Well, I'm using one of these things.
Oh yeah, that's what I was talking about. Okay, yeah, all right. Maybe you're just drunk. Maybe you start hitting the bottle too early. San Diego, you guys don't work a full 8-hour day, do you? Hey, Ammar, just FYI, you should short ExxonMobil. The reason you should short it, because I bought 100 shares a couple of days ago, and of course, it's since got destroyed. I just need to tell people that short what I buy, and you will get rich, man. You will get rich. The first individual stock I bought since I had the Qs back in the early 2000s. And of course, the minute I buy Exxon, kaplunk, kaplunk, kaplunk.
So there's in the insurance industry.
Yes. Yeah.
What qualifies as permanent insurance, right? So we talked about the premiums do not equal the cost of insurance. There's whole life, there's universal life, there's variable universal life. There's also index premium insurance policies. There's equity index premium. So there's tons of different policies. Basically, whole life is the most conservative because the investments are based off of a table. So here, when I mean so the insurance company charts out a table, and if you put in that premium, that's what your account value will be. So essentially, the insurance company here is taking on all the risk. Universal has a interest rate, like it's pegged against like a certain interest rate, and you get plus or minus something of that interest rate. Variable, it's kind of like a 401k where they have a list of 40 to 50 funds you can choose from, and then you take the risk on the performance of the investments. And so I guess index would be somewhere in between here. So between these three, this is the most conservative. This would be the most aggressive. So in terms of what policies are best for this, it really depends on your personality. If you're somebody really aggressive and you have a longer time horizon, it may make sense to take on that risk. But if you're more conservative and you're like, I don't want to have this plan blow up, then you probably want to get a whole life policy. But I don't know if that answers.
Yeah, that's right. So just the issue with permanent life insurance is everyone assumes that it's permanent is whole, and whole life is just one of, like Ammar is saying here, 4 different types of life insurance. And it's important to understand, the average person doesn't need to know all this, but the average person needs to know how to find this information for sure. So Mar, let's see here. Would the trust have to pay income taxes on any yearly income not distributed from the trust? Talk about an ILIT, assuming it is an accumulation trust, or the kids be able to take the income out each year?
Yeah. So what does happen is, let's say uh, both of the insured people have passed away, so now the children have the trust. The trust is going to issue K1s for the distribution from the trust. As long as that distribution exceeds the rate of return of the trust, the trust won't file a separate tax return. If and I've seen it both ways, where they intentionally don't distribute the max, and so it gets taxed on the trust, and then there's a separate K1 for the children. So I know this is not a very definitive answer, but it depends on how it's structured.
So if ILIT has its own tax ID, is what you're saying, and there could be tax consequences if, depending on the way it's set up initially.
Yeah, it definitely has its own tax ID, and I definitely would say that because the life insurance product is tax deferred, there's no tax filing on the accumulation part of the insurance policy. However, on the distribution, that life insurance policy is no longer there, and it's put into a regular brokerage account, right? The death benefit of the insurance policy. And so that can kick off a taxable situation on the trust.
Did you want to go over that illustration you had done for me?
Yeah.
This is this is where the rubber hits the road. Well, I like the illustration because all this is good, but until you actually see it in play, you can see I have a partner who's joined me here, Grumpy McGee, aka Pablo. Yeah. So here we got. Oh boy, this guy's getting heavier, even though you're only. I don't get it, buddy. All right, let's see. Hold on just a second. I see it. Okay, there we go. Looks like we're able to see it.
So I'm trying to get this bookmark thing to open here, and I'm clicking right here, but it's not popping out. There we go.
Gotta be patient, Ammar. I thought you guys in California would chill. Be patient.
So I think I want to cover two parts real quick before we get into walking through the illustration. So this is a second to die policy with the increasing death benefit. Let's do this one. A level
valued client is me because I'm valued.
So remember, I was talking every year you get these buckets that you're building, and each year in that bucket there are different levels of funding. So we're going to walk through those levels of funding, right? So the first level of funding is this 285 times 12. So let's say 3,400. So if you put 3,400 every year, or every month, or every year for 20 years, the policy is going to be guaranteed in force to a certain age, right? That's this first number, right? And I'm going to draw this out here in a second. Okay. The target premium doesn't really mean anything, right? What Josh and I are showing you here is a full insurance hypothetical.
Yeah, exactly. Yeah.
Most of the time, what you'll get is like a summary or a consolidated, like maybe 9 pages, 8 pages, of which 3 to 5 pages are disclosures. This one's 30 pages. So you want to get the full hypothetical, which has a target premium, and read it. Target premium, this value is used in the calculation of the producer's compensation. It means nothing in terms of funding value of your policy. The modified endowment premium, this is the MEC, right? So that's like the max that you want to put in any one given year. The guideline annual premium, this is what, to fully fund a policy properly, this is what you need to put in, right? And that is to make sure that the policy stays in force and it's continuing to grow, right? So let me go here.
The last one's the GSP is the interesting thing. That's what I like for folks who have some money sitting on the side.
Yeah, so we'll get that one here in a second. Let me just draw this out. So It's very clear. So every year we're creating these buckets. And I guess I'm not used to drawing and not looking at my pen and looking at the screen. So I apologize for that. So this was that 6,000. You remember what it was, Josh? I already forgot.
I think the guideline was 6,000. The other one was 30. For the 20-year one was 3,500.
Yeah. All right. So this is 6,900.
Yeah.
So let's just call it 7,000. Let's use round numbers. 7,000 is the max.
Yeah.
You can put in every year. 3,500 is the minimum to get no lapse guarantee. Right. So, somebody could quote you a $500,000 policy with putting only $3,500 a month in, and you're like, wow, this is great. It's way cheaper than my other quotes that I got.
Right.
It could be totally misleading because you're minimum funding the policy. And you can get a quote for $7,000, annual premium. And it could be totally, you could feel it's way too expensive, but it could probably, a couple of years of funding, and then you can stop funding it, right? So it all depends. But what the key is here is, let's say you fund it halfway. I'm just going to use round numbers and say 5,000 a year. And then something happens later on down the road and you don't have enough money. Well, you can stop paying that year's premium because you have enough extra cash that you put into the policy, right? The other thing that could happen is, let's say you get an inheritance and you want to add it to the policy, right? Well, this is kind of like a Roth IRA, except you get to go back each year and make sure all these buckets are fully funded, right? So let's say in your fourth year, you put your normal 5,000 in, but you have an extra 20,000. Well, you want some flexibility in the later years. You can come here and say, hey, since I have this money now, I'm going to put in fully fund this one, fully fund this one, fully fund this one, fully fund this one. And the important thing to know is that the cost of insurance is staying the same for that given year, right? So a majority of that money is going towards investments, which then can compound and grow over time, right? So I think that's important to kind of note.
Absolutely.
So I'm going back to the
illustration.
Yeah. The one thing that Josh talked about earlier was his GSP, right? And GSP is guideline single premium. So this is, this is an insurance product. It's not an investment product, right? We got to be perfectly clear, right? And in the earlier years, individuals would say, hey, I love this tax deferred and tax-free benefits. I'm going to just buy a small policy and put a ton of money into it, right? And then through regulation, they created what's considered the guideline single premium. So this is a single premium you can put into the policy. So if you had 81,000, you could put that in one time and never have to fund these policies again. And it would be guaranteed for the no lapse guaranteed premium time frame.
And the nice thing about that is you're putting 81,000 in, and you're just assuming this is guaranteed. I don't know. Let's just assume it's 100% paid up. That means, if I'm 55 years old, and I take my trusty calculator, I put 80,000 in, I know exactly what my internal rate of return will be on any given year. If I die tomorrow, not my wife, because it's second to die. If we both die together, our kids are getting $500,000 off an $81,000 investment. If we die 45 years from now, you just take a trusted calculator and you're getting 500. Your heirs are getting 500,000 on an $81,000 investment over the course of 50 years or whatever. It's actually quite cool because you can say, look, I know at the end of the day, this is what I'm getting. No risk. That's it. Unless you have a policy that's not really paid up or something like that. But I'm a big fan of that for sure.
Yeah, and so I should probably point out like two big. So one big thing to consider here is this is non-market correlated, right?
Yes.
At the end of life, this is a designated dollar amount, right?
Yep.
And so I've had clients that have passed away like at the end of 2008, and they needed the beneficiaries needed to generate money, and they sold investments in the beginning of 2009. Probably the worst time to sell investments,
Yep.
right? And the other thing that we should kind of say is that for individuals that want, you know, I don't want to say control, but essentially it is control, right? If you want to control more of the moving parts over your lifetime, this is one way to do it. It's not the only way, right? There are other options, there's other solutions, but there's nothing as simple as a life insurance policy where there's a owner, death benefit, and a beneficiary.
It actually is. So I'm trying to calculate here. Ammar, give the same thing. So if I'm 55 and we have 40 years, and I got 81,000 as my present value, no payment. My ending value is 500,000. 40 years, I get a 4.6% IRR. Does that sound about right?
Sounds about right?
Yeah.
Because 40 years, you'd be 95.
Yeah. So that's what's cool is they're saying, okay, now what they're doing, because they're covering two lives, it's not just for me, it's for Charlotte, who's going to certainly survive me with all the hot air I blow out here. Talk about CO2. I spew CO2 all over this house. It's not carbon monoxide, it's carbon dioxide. So other than getting very green, so what's going to happen is we say she's going to survive me. She won't get the money at her death because it goes to the kids or goes to the church or goes to a trust or whatever it is. But we know exactly what the IRR is going to be. It has nothing to do with stocks, has nothing to do with bonds. You know, the Bolsheviks come over and we're all dead anyway, so who cares? But other than that, we know that there's a IRR, internal rate of return, that we can hang our hat on, which is pretty nice. So if you get a big fat bonus, a big fat lump sum of money, you're like, what do I do with this? Well, the first thing I say is, do I need it? Does Charlotte and me need this money? No. Well, now you have to be underwritten. I get this question a lot too in long-term care. It's one thing to run all these numbers until you're underwritten is all for naught. Underwritten means you got to be approved. The life insurance company. So what happens with the life insurance companies? They want you to live as long as you possibly can. Long-term care companies want you to die as early as you can. They have competing odds, which is why a quasi long-term care life insurance policy is just odd to me, because there's two completely competing entities there. One wants you to die, one wants you to live. Inherently can't be very efficient use of your resources. So, but this is how second die works. And we, like I said, just real quick, Amar, we used to have one, and we had it because I was going to leave that to my kids and then leave the money in my 401k to the church. But when I started my business, I said I need the cash. You know what I'm saying? So we cashed it out. But you know, if we have a couple more good years like we're having the last couple, I'll probably do it again, because I do believe it's a wonderful way to leave money to the kids and leave money to the church as well, or whoever. I don't care. Just not the Bill and Melinda Gates Foundation, because they're going to force vaccines on you tomorrow. So we want to make sure we're giving it to whole righteous people, not Bill and Melinda. That's for sure. Excellent. But anyway, so that's pretty good stuff. So what happens in this regard too? Now, Ammar, on that the illustration, the guideline premium said if you pay this for 20 years, it still did not guarantee it though. It just said after 20 years, what exactly could happen, because that's, you know, that was a pretty inexpensive policy, but it's not guaranteed, at least because it had that 20-year thing. So explain what that 20-year thing meant.
Yeah, so like if you do the minimum or the no lapse guarantee premium,
Yes,
is what's called, that gets you to the minimum funding for the first 20 years to guarantee that policy stays in place. Now, keep in mind with these policies, if you're trying to get the most amount of leverage, you want to put the least amount of money in.
exactly.
So they're trying to show you the range, the full range that you can put money in. There are different funding levels, and with that, the more you put in up front, the more your premiums can stay level over a period of time, and you don't have to worry about the return. So in a policy, there's three, actually, let's just show here. There's three Trying to share. Can you see my
Amar
screen?
broke a rib the other day mountain biking, so if he seems kind of out of sorts,
Yeah.
pain, and he's too tough to take some pain tranquilizer or whatever. So
Yeah.
he's like, oh, I said, man,
No pain meds for me. No, trying to tough it out. But so there's three. Usually you'll find three columns in an illustration. The first column is guaranteed charges. So these are the guaranteed max that the insurance company can charge, and then they charge that every single year. And they put the lowest rate of return that you can get, which on most policies is zero, right? So zero return with the guaranteed max expenses every single year, right? So in this case, this policy, you can see here at age 75 and 70 for these clients, the policy would lapse.
go down. Is that?
Oh, sorry,
Yeah,
94.
right.
Yeah.
It just has no cash value, but who cares about that?
So even if a policy has zero cash value, that doesn't mean the policy is gone, right? Because if you could be still be making premiums. The midpoint is calculated on the averages to 1/2 of what the current today's rate is, and what the guaranteed are. So it kind of self-defining there, the midpoint, but it's not taking what all the past year's expenses are. They're just taking the current year. So that's something to keep in mind, and the current year interest that they're paying. And then the current charges, this is, I guess, the greenest side of the lawn here, where this is what the expenses are today, and this is what the returns are today, and estimating that for every single year going forward. What you'll find is like there are different ages where these policies lapse, but most policies these days, they lapse at age 120, right? Where the insurance company says, hey, we give up, we're going to give you your money back. It's called an endowment, right? The policy endows. And so in an endowment policy, the insurance company just says, I give up, and they return all your premiums.
So before that, you want to jump off a bridge. So if you highlight the year 39 there, end of year 39, all right, so just assume that, Charlotte and I died the previous year, all right, guys? So if you look at the net benefit, we're still having $500,000 of death benefit, even though we have no surrender value. However, if we have the highest, the greener side, we have a surrender value of, what's that, 280,000. But we still only have a death benefit of $500,000. So when we're trying to do these things, this is where my man was asked about life insurance. When you're trying to do a life insurance, you've got to get it what you were trying to accomplish. And if I'm trying to accomplish a larger surrender value, that doesn't make sense when you're trying to have a second to die policy. Mostly, it doesn't matter what the surrender value is at my death. I want to essentially be zero. That's what I'm trying to shoot for. And this is where USA, for instance, it just never worked because they had high cash value policies, which meant they're expensive, which wasn't a smart thing for second to die. If we're using life insurance as a estate planning tool, we'd much rather be on the guaranteed charge as opposed to the net surrender value. Now, someone might say at the end of the day, but Josh, I want access to that money. Then if that's true, then we got to think, what are we trying to accomplish here? Are we trying to sell it for you have access to it, or are we trying to accomplish it for an estate planning mechanism? So again, we have to kind of dive a little bit deeper there. Did I see a comment on there? Or was that, I thought, maybe just highlight. Okay. And this is where, look, we don't have to solve this, but what it comes down to is when you're talking life insurance is a tool. And just like any tool is like a firearm, it can be used well, it can be used poorly. That's all there is to it. But not to at least consider life insurance, I just find to be, I think that's a big mistake. And I know a lot of people want to buy term and invest the rest. I get that 100%. I just think there's more to the story than just buy term because I can get higher on my stocks, especially when it comes to estate planning. Let's see. My man says, Ammar, Angelo can you have the life insurance company distribute the funds annually, or would you think it's better to have the policy pay to a trust, which can then hopefully pay out to your wishes or your wishes? What's your thoughts on that?
Yeah. So the life insurance company, has most life insurance company has an option on the beneficiary payout, right? So if you're not setting up a trust, depending on the life insurance company, you can choose, do the children in this example receive it lump sum, or do they do equal periodic payments, kind of like a immediate annuity where the same insurance company invests it and then turns around, sends like a monthly, quarterly, or annual check to the beneficiary. So depending on the insurance company, they're both options.
Yeah, absolutely. Go out of this real quick, Amar. And so a lot of times with life insurance, what you would want to do in that case, Angels, like I said, here is a lot of times people say, look, I don't want my kids to sniff this up their nose. I do want them to get a regular basis of income that they can at least spend and sniff that up their nose, but not the whole thing. So they just set up a single premium immediate annuity, a SPIA. So it's a $500,000 death benefit. We're going to give each kid $2,000 a month, or what, I'm just throwing that out there, essentially for the rest of your life, and or 20-year period certain. You would set all that up in the contract. And we call that a poor man's trust. If you want to have a similar mechanism of a trust, where you're saying, I do not want my kids to blow this on the horse races or something like that. A SPIA is a wonderful thing. A SPIA is a great thing because it tells
it. SPIA is single premium immediate annuity. So it's taking that lump sum and then distributing. And how they do it is they calculate, the payments, and they discount it to a present value to match what you're putting in.
Yep, absolutely, and that's a good plan too. I just, the drawback, Frank, about the trust setup, and I think a lot of people overlook this, is that the who is a trustee. Hell, I can't tell you how many people can't even decide on an executor of their wills. I'm like, well, who's going to be a freaking trustee? Because remember, a trust is something you're setting up essentially for control from the grave. An executor, all they're doing is they're making sure the probate is going to the right places. So you got it, Angela. So a trustee is someone who says, Ammar, I'm trusting you to manage this on behalf of my children. Now, it's more than just that. Ammar has a fiduciary responsibility to the beneficiaries, and if Ammar screws that up, he can be held accountable. And guess what? The beneficiaries can say, Ammar, you should never have bought Tesla. You should have bought Nikola or something like that. And Ammar says, and he could be sued. It happens all the time. It's a cottage industry of suing trustees on estate plans because it's kind of easy. Ammar's like, I'm just using you, Ammar. I'm just saying, most of the time, it's just your Uncle Bob. And Uncle Bob's like, I didn't know I was going to be this involved in this. I didn't want the freaking some meth head to tell me that I wasn't given the money that they were promised, and now I'm being sued because it's crazy. So
yeah, so I would say there's two big considerations with trustees. One is family dynamics, right?
Yes.
Like in your example, do you want Uncle Bob to be saying no to your children or yes to your children? Playing good cop, bad cop in terms of distributions. And then the other thing is age, right? So a lot of people pick a trustee that's a friend, a family member that's relatively the same age as they are.
Yep.
The problem is when these trusts actually go into place, you're a lot older.
Yep.
And so, my company, Client First Capital, we provide trust services, right? And I guess it's a shameless plug, but in the sense that, we'll be around throughout the distributions of a trust, right? And most corporate trustees is their mainstays, that we're insured, we're licensed, we're bonded, and we have to do exactly what the trust terms say. And since we're a corporation, we're going to be here longer than any one individual.
Yep. And you're going to pay for it. I mean, that's what happens.
We charge a fee. Yeah.
Yeah. And it's that may or may not be reasonable, but that's one of the reasons when it comes to having the life insurance, you can make that decision on the front end. You want the life insurance to fund a trust that we've managed over multiple generations, or do you want to just pay out directly to the kids? There's so many different dynamics here that, not to at least consider the life insurance. All right, so Ammar, who would be benefit to use second die life insurance? What would be the ideal person that you see that says, this guy should be thinking about that?
Well, I think we addressed it earlier on. The first thing is you got to make sure that you are taken care of, right? As in the grantors, right? Like as Do you have enough for your own retirement income? Are you going to want to leave a legacy? Are you going to want to have some control on that legacy, right? So first, make sure you have enough, right? Then you have to decide, all right, I don't want to spend, I want to leave something to children or to nieces, nephews, whoever it is. What's the most tax efficient way to do that? Number one. And then number two is, do I want to exercise control, right? Like, do I want to make sure that this is a payment stream, or do I want to make sure that there's some restrictions, right? Like, yes, you can have a car, but the car has to be, within livable, lifestyle standards, right? You're not getting a red Corvette, you're getting a red Honda type thing. And so typically what we've seen is that these products have only been catered to people that were above the exemption amounts.
Right.
But with the Secure Act, that these products, which, I mean, there are tons of products out there. You just have to find the one that fits your needs. These products are now, what we're seeing is at least people that are below the exemption amounts, but do have a charitable intent, and or they want to exercise control, and they hate taxes, right? They don't want their kids to be left with the tax bill from the IRA, or they want to make sure that there's more control. So yeah, I'll leave it at that.
And let me just, someone who's got a couple $1 million in an IRA, this is a beneficial thing for sure. Now, the drawback, as I said before, is that your underwriting, it has to. So just because you might have, was it type 1 or type 2, whichever's the list, doesn't mean you're not going to get qualified. It really depends on the worst of the two people. But I just tell you, man, it's like, a lot of times they'll be like 75 years old, they want to get second and die life insurance. It's going to be tough to get through. Now, you can't discriminate. You got to say anyone can apply, hell, but I'm just telling you, a lot of times it's tough because the life insurance company, they're not stupid. They have the smarter actuaries than Ammar and me combined, because they say, look, we know to a man when people are going to die, and we know exactly when we're going to pay out. Yeah. Thus, the younger you are, that's why Charlotte and I did this 6-7 years ago, because we were young and better. Well, we're still in decent shape, but we're young and 6 or 7 years ago. So it's cheap, you know what I'm saying? I say cheap, it wasn't cheap, but it's like $100 a month for a 300,000, I can't remember what it was. But anyway, it was inexpensive, because the younger you are, the less expensive it is. So if let's just say you're kicking butt, taking names at running your own RIA in San Diego, and you're like, man, other than breaking ribs, you're like, I'm kicking butt and taking names. I got money coming out of Yahoo. And I'm, instead of giving it to Bernie Sanders, maybe what I should do is I should buy a second to die policy to make sure my kiddos and who knows, grandkids have a tax-free inheritance upon my death. And I'm not saying that about Ammar. I'm saying about who am I saying about? Ammar's neighbor. Actually, I don't know Ammar's a Bernie Sanders guy. I'm just joking. What I'm saying is there's better uses of your money than just saying, I'm going to wait till I'm 80 years old and start having massive amounts of required distribution for which you have to pay tax on. Think about it. If you got the cash flow, man, think about it earlier, or even better, we call it drop in, a lump sum, just a one-time drop in, like that $81,000. Then you don't have to worry about it again, ever. You said, done, I'm paid up, is good. And then you don't have to think, and you still have access to some of that money, given that if things went bad, like I still can draw some of that money out depending on how much it's worth. We don't know how much that'd be, but
yeah.
Last thought.
Can I just put my contact information on the screen?
Yes.
If people have questions, I built this little card. Can you see it there, Josh?
Yep, absolutely.
So this is our website, clientfirstcap.com. You can email us, and here's our phone number. And Josh, you're going to put this in, like, I guess, show notes or something, description.
Yep, I'll put all that in the show notes, and I put on there too. Let me just do it well here. I'll put in the notes about Ammar's YouTube channel, because Ammar's there. Let me put that on again. Because Ammar is getting back on the horse or whatever it's called for doing his YouTube channel again. So it's good. And Ammar is a good guy. You clear through Schwab, right? Or TD?
Well, yeah, we're custodian agnostic, so we have Schwab and Fidelity as custodians.
So Ammar, so he manages money, does insurance stuff, financial planning as well. And I'm a big fan. Amar's one of the good guys in the business for sure. That guy Jason from the other night works with Ammar as well. So you get a kind of a team. But Ammar does run his own show. Seems like so I'm gonna put down the show notes, and then and folks, you guys have questions, just fire away. I mean, you don't have to do it right now because I'm getting actually kind of burnt out because Stinky McGee here. Look at that guy. He's like, hey, paw the like button, paw the like button. But so if you want to get in touch with Ammar, absolutely sign up to his YouTube channel, and you got like an email list or anything, Ammar? Or
We do a bi-weekly newsletter that goes over retirement topics as well as concerns in retirement, and we cover investments, taxes, and estate planning, Medicare. We just got licensed to sell Medicare insurance.
Okay, cool. I did not know.
So maybe we can do another live stream on that,
right
Josh.
on.
The differences between supplement plans and having Medicare Advantage, pros and cons. And so if you go to our website, at the very bottom, there's a place to put your email where you can subscribe to our newsletter.
So if you want to throw your disclosure thing on there, Ammar.
So we're wrapping up, right? So let me go to.
And thank you all for being here for sure. And we'll see you guys again to Sunday. I think tomorrow is going to be my Subscribe Star only live stream, but we'll do another one. And then of course, Sunday we'll have our normal 7 p.m. Live stream as well.
All right, Josh, let me know if you can hear this.
Okay.
The opinions expressed in this program are for general informational purposes.
Not well.
And are not intended to provide specific advice or recommendations for
There you
any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place.
All right.
That's good stuff. Let's listen to that 20 more times. Hey,
thanks, Josh.
Tomorrow, Jill, 7:30. Jill, did you get the notification on this? Hold on a second, Mar, don't hang up. I guess I'm in charge of this, but we'll do a 7:30 because I do know when I do. Okay, here we go. Here's another thing here, Mar. Hold on. Instead of a life insurance policy, you're better off buying a cash flow flowing duplex or triplex that pays that tax-free cash all along the way. If you die, your loved ones can sell it with full appreciation. That maybe we can debate that. He's a medic, Ammar. You know those medics, kind of like those engineers and CFAs. Always got to overanalyze stuff. All right, brother. You're a good man, Ammar. I don't care what your wife says. You're a good guy. We'll see you guys.
Thanks. All right, bye. Thank you.
See you, man.
Yep.
All right, bye.